Hey everybody, welcome back again. Julie and I, we're talking France today and we're talking taxes. We had so many requests about the French tax system from our four-part series. Yes, that was 4 videos about France residency and healthcare and where to go and all these things. So check those videos out if you haven't. But French tax apparently is a hot topic. And if you're going to live in France, we're Americans. But if you're Canadian, if you're from the UK or you're from Australia or something, you're going to want to stick around if you're thinking that you want to go and live in France and see how maybe some of the laws that France have that aren't really normal in a lot of cases compared to many other countries, how they may impact you, and will that make your decision to come or go a little bit more difficult. So right now we have with us Sandra, and Sandra Veneer, welcome, and we're glad you're here with us.
Hello, everybody. I'm glad to be here with you to talk about taxation. It's really important, just for a disclaimer, to know that every situation is different, that there are many exceptions, and that your situation should be examined by a tax lawyer in France to avoid any problem. I will give you some general situation, but we have a lot of exceptions.
So if someone wants to come to France and they're going to come and do the long-term stay visa in France and apply for their year and maybe go on to residency after that, what can they look at or have to think about as far as their tax situation?
So we look first to the French internal law. So under French internal law, there are 3 main alternative criteria to qualify as a tax resident. The type of visa, so visitor visa, resident permit, entrepreneur visa, does not affect tax residency. If you checked one condition, you will be considered as a French tax resident under French internal law. So the first is the personal criteria. That means you have your lieu de séjour principal in France. It's your household. That means the place where your family meet, spouse, partner, and dependent children. Or if you don't have any dependents and you are single, it's the place, the principal residence, your main residence. The second criteria is a professional criteria. That means you have your main professional activity is in France. So your main professional activity, salaried or not, is carried out in France. The third criteria is an economic criteria. That means you have the center of your economic interest in France. So the place of your main investment, the seat of your business, or the place from which you derive the most of your income. If none of the above can be determined, tax residency may be established by a simple calculation of days spent living or working in France. That means it's the place of your mainstay, more than 183 days per civil year in France. It is quite possible that you will be considered as a French tax resident under French international law, but also a US tax resident because you have the US citizenship. In this case, the tax treaty between France and the US will determine your place of tax residency because you cannot be a tax resident of 2 countries. So that means the tax treaty gives us 4 criteria. The first is the state in which you have a permanent home. That means a home available for you continuously. So if you have a home in US, but this home is rented to a third party, it's not available for you. If you have 2 permanent homes, it's a possibility. It's the state to which you have your personal and economic relation. So that means the center of your vital interest. For example, it will be the family and social relations, your occupations, political, cultural, the location of your business, the place of your assets, all this information. If you have 2 centers of your vital interest, if it's also possible, it's the state in which you have an habitual abode. So you don't have any precision. So that means if you stay 5 months in France, but 4 months in US and 3 months in Spain, you will be considered like you have your habitual abode in France, even if it's not 6 months. If you have 2 habitual abodes, the state of which you have the nationality. So like I said before, every case is different and depends on your specific facts and circumstances. The most important thing you can do if you are wondering, am I a French tax resident? Do I have to file a French tax return in France? Is reach out a lawyer to assist you to understand your situation and to know if you are or not a French tax resident. So the second step, now we made the French tax residency, and now we determine if you are a French tax resident. Like I said before, you must declare all your worldwide income independently on the source of it. But it doesn't mean that they will be taxed in France. It is necessary to study the tax treaty between France and US to determine the place of taxation of the income. For example, for retirement pensions, it will be your question. So retirement pensions, social security, IRA distributions, all these forms of pensions under social security or private pensions are taxable in US if they are paid by US government or by US entity. So that means if you received retirement pension under social security, or you have an individual retirement plan or a qualified plan like 401k or 403A and B, where you have a lot of individual planning in US, all these type of individual plans and the pensions will be taxable only in USA. So this income gets reported in the French tax return, but you benefit from deemed tax credit equal to the amount of the French tax. So that means at the end of the day, you do not pay taxes in France on this income.
Well, that's good news. Now, I do have a question on the PUMA, which goes towards paying the health program. So if you become a resident in France and you want to go into the national health system, I guess I got 2 questions on this. As I understand it, if you earn over 50,000 euros a year, anything above that will be taxed to give you the health program. And I think that would also potentially include some of the 401k or Social Security, correct me if I'm wrong. And then as far as signing up for that, if you're on the long-term stay program and you choose to, can you stay on private insurance rather than going on to the public health system, or is it a mandatory that you go to that public health system in case you decided, hey, paying $500 a month for insurance or $300 a month for insurance on your own was a better way than the tax burden?
So to answer to your question of it is mandatory, you have contradictory answer to the URSSAF. The URSSAF is the French social security body. So you have some center of URSSAF will say, no, it's mandatory. So that means if you have a stable and regular residence in France, you have to pay this tax. But you have also some center of URSSAF will say that it's not mandatory, because normally you have to file a document and to have the information. If you have, I don't know, dividends, rental income, this information will be filed in your French tax return. So the only way to have the information for this social security body to calculate the PUMA tax is for them to have your French tax return. So that means if you don't file any French tax return, they cannot know that you have to pay these taxes. So it's not clear path, but I think if you don't ask the PUMA tax and you don't file any French tax return, if you stay, let's say, less than 1 year, normally you don't receive any notice of the French social security body to pay this PUMA tax. This PUMA tax is related, like you say, to the French healthcare system and used to finance the social protection in France. So in short, this PUMA tax applies to French tax residents who do not receive enough active income subject to social security contribution. Like I said before, this contribution is calculated based on information provided by the French tax administration. So that means you file your French tax return and you have a specific case to indicate the revenues like in rental income, dividend, interest. And this is this file, this box, and this box will be communicated to the social security body in France, so URSSAF.
The health system for France is fantastic overall. Correct me if I'm wrong, once you're part of it, it's like zero deductible, everything's covered under the health system. So if you're coming in on Social Security in your retirement and you're not over 50,000 euros a year, you really get this pretty much for free, if I'm not mistaken. However, if you are coming in over 50,000 euros, what percentage is going to be taxed to be part of the health system? What can somebody expect to pay?
Is it 50,000 euros or is it $50,000? Because I thought it was 46,000 euros.
In fact, who is liable for this tax? So you have the French tax resident who meets 3 cumulative conditions. Very important to have 3 cumulative conditions. So you work in France or you have stable and regular residence in France. Your professional income in France are less than 9,000 euros approximately. And you have income from assets and capital exceed 23,184 euros. So it's the limit. So that means if you have more than this threshold of 23k euros, you have to pay these contributions if you don't receive any professional salaries.
But this is where there's a Julie and I, we always think of a couple, and I apologize to the audience. So when I'm giving out some of these numbers, I'm looking at it, okay, so it'd be 46,000 euros for us, but for the individual, it's 23,000 euros. So it's a combination. So my numbers are way off for the individual.
46k euros for the threshold. It's a combination of both of you. Okay. But in fact, the contribution can be lower. So the contribution rate is normally set at 6.5% of the amount exceed the threshold. So for example, for an individual, he has 80k euros of income from assets and capital. So assets and capital is dividend, interest, rental income, non-professional activity, like for example, vintage in France, it's non-professional activity. So you have to declare the amount. All these elements will be considered. And if you have like 80k euros, the PUMA tax will be 3.7k euros. So that means it's not a high amount, in my opinion, to cover all the healthcare in France. It's 6.5% of the amount exceed 23k euros for one person.
Yeah, so that's, you know, that's really reasonable. So if somebody was making 30,000 euros, they're only going to be paying tax 6.5% on the 7,000 or 6,000 euros above that threshold. So it's going to be a fantastic deal for a lot of people. And if you're a couple, then you double that amount. But it's based on the individual. So let's say in Julie and I's case, let's say that a lot of the income comes in under me and less income comes under Julie. And so maybe Julie isn't going to hit the 23,000, but I'm going to be well above it. Am I able to take advantage of the parts she's not using and be combined as a 46,000 as a couple, or is it?
Normally, because you are a couple and in French tax administration, you will file one French tax return. I think you have a combined because the French tax administration cannot know if the dividends are for you or for Julie because we have only one box for dividends. For salary, we have one person one, person two, but for dividend and all rental income, we have only one box. So we cannot know. So we presume that it's half. For example,
let's talk about your freelancers or people coming in making an income. What are they looking at as far as obligations to the French tax system?
So for freelancer, it's a little bit complicated. Why? Because you have two things. You have freelancer registered in US and they come to France and they don't want to register in France. So that means it's a possibility to have only to stay register in US. So it's a possibility. But in this case, we have something called permanent establishment. So that means the French tax administration can say, I think you have a permanent establishment in France because you worked from France. If you work from France, you have some premises in France. You send emails from France and you teleworking from France to be short. So in this case, the French tax administration can say that the revenues will be considered like French revenues, so they will be taxed in France because you have something called a permanent establishment in France. Even if you are registered in US, but in this case, for example, you are registered in US, but you don't travel to US to exercise your activity. So that means, in fact, in US, you don't have any premises, you don't have any real activity. As a freelancer registered in US, you can be liable for taxes in France because you have something called permanent establishment. But you have like some exception, and it's necessary to have a tax consultation to be sure and to avoid maybe to pay taxes in France and to remain in US. Maybe you can travel in US like one per month to exercise your activity and to have ties with your activity in US.
Okay, so if somebody wanted to come over and they're employed from the United States and they're going to come and use their income to show that they can sustain themselves, and you can refresh for our audience here in a second to make sure the number is right, how much do they have to show to qualify for the long-term stay visa. But if they show that they were making an income from a US employer and they come over to France then, and they plan on spending a year, what is the amount that they have to show to qualify? And then how would it be just 6 months? Once they're in the country for 6 months, they can be potentially having to pay tax to France. And what is the percentage of of tax that France will take from a person?
So for the minimum wages in France, so you have to prove that you have the minimum wages in France, and the minimum wages in France is 1.4K euros net. So that means after social security contributions. So per month. So that means you have to prove that you have 1.4K euros per month. In fact, a lot of people, a lot of foreign people reach the threshold when they come to France. So it's not a problem. It's the first thing. The second thing, like I said, if you are a salary of a foreign employer, so you can come to France, but you cannot work for the French market or to have French client. Because if you work as an employee in the French market, you will be considered like to exercise an activity in France. So that means you will apply for another type of visa, because long stay visa, visitor visa will allow you only to stay in France, but not to work in France.
So if they were showing income from an employer to qualify for the long-term stay visa, to show that they can meet that minimum, what is the amount that's going to be taxed? But you're also just saying that they can't work from France, but even if all of their work is going to another country outside of France.
For the 1.4K euros for the minimum wages, you have to prove that you have some, for the visitor visa, you have to prove that you have this income on your account. So that means if you have like some 1 year of substantial amount, so I don't know, 24K euros for a little bit more, 26K euros, you have this amount on your account, you will reach the target to prove that you will have. In fact, you have to prove that you can survive. You can pay for your own rental. You have to pay for the food, and pay for the day-to-day expenses. So but if you have this amount on your account and you don't work, it's not a problem. You just have to prove that you have this amount on your account.
Okay, so that won't be taxed. But if you are working and you do come and work, what is the tax percentage?
If you are an employee of a foreign employer, it's a possibility that you will be taxed in France for the revenues you will receive from this employer. Why? Because the tax treaty between France and US state for the salaries that salary received by an employee of an American company are in principle taxed in the United States unless the employment is carried out in the other state, so France. The OECD commentary on this article states that employment is exercised at the place where the employee is physically present when carrying out the activity. So teleworking is physically carrying out in the employee state of residence, so France in your case. So that means if you physically work in two countries, the taxation will be divided in the two countries. So for example, if you work, let's say 2 days in France and 3 days in US, not consecutively because it will be complicated, but for the year, 40% of your salary will be taxed in France and 60% in US in our example. So it's very important to see. We have like something called temporary mission clause. It's an exception. The salary may still be taxed in the country where the person is tax resident. So if you stay US tax resident, the salary may be still taxed in US if you met some conditions. But we have to study case by case because it's a very complicated clause to understand, and we have to make some calculation. So it could be very complicated. So if you have French revenues, so the French revenues will be taxed in social security contributions and income tax. In France, we have always these two types of taxes, income tax and social security contributions. Social security contributions on active income like salary, it will be for an employee, the employer pays employer social security contributions at a rate of 40%, and the employee pays employee social security contribution at a rate of 25%. For an example, if you want to have 2K euros in your pocket for the employee, it will cost approximately 3.5 to 4K euros for the employers. So like the double, for example. So it will be very high taxes. And after that, we have income tax. And income tax in France is calculated based on your fiscal household, foyer fiscal. So that means if you are a married couple, you have to calculate it both of your remuneration. And we have a tax scale bracket. Okay, so for example, for 2023, income tax scale, it's important to understand that this scale is revised every year. So that means for 2024, he will probably be different. And also we have major elections in France. So that means we have a proposition of a party to have a 14 tax scale bracket. So for now, it's this income tax scale, but it can change for next year. just to be sure.
Okay, so it's a scaled up. So if you're going over 82,000 euros, which would be roughly $90,000 right now, then you'll hit the 41% bracket for anything above that amount. Okay, that's understandable. That's actually a little bit better than I was anticipating, because I was hearing the stories about people with 45% tax brackets. And I thought that threshold was going to be a lot lower than 177, but not that 41% is much better than that. But at least you can get to $90,000 approximately if you're talking US dollars before you hit that higher 41%.
For the dividend and interest, in principle, if you are French tax resident, dividend and interest are taxed in France according to the tax treaty between France and USA. It is also possible to have deducted at sources in the USA. In France, these revenues are subject to income tax at a fixed rate of 12.8% for income tax and social security contributions at a rate of 17.2%. So that means 30% of total taxation. We have an exception, and it's a good exception for US citizens, because as a US citizen of the United States and a French tax resident, the tax treaty states that you have a tax credit equal to the French tax on interest dividends from US sources. So that means paid by US company or debtor resident in US. So that means, for example, in the same investment account, you have dividends received by Apple. You will have to declare them in France, but they are not taxable in France, because you have a credit tax equal to the amount you paid in France. But if you receive like Samsung dividends, it will be taxed in France because it's not US company. So it's very important before you move to France to go to your US advisor to be sure that maybe not all your assets, but all the assets in the investment account, for example, can be considered like US sources to avoid to pay taxes in France.
So let me ask a question, and you let me know how you would answer this. We have what's known as ETFs in the United States, which are going to be a type of you can find them on the stock exchanges, and it's a group of many stocks. Some of them may be foreign, some of them are American stocks. There's a blending. There are stocks that are listed on the American exchanges. So first off, I'm assuming that a foreign company that's listed on the American exchange is not counted as an American company, or is. And if not, if they're part of a group of ETFs that are made of could be 20 or 100 different companies, will they be looked at as a foreign stock or a American stock?
Unfortunately for that, it's complicated because, like you said, you have foreign company and you have American company. So that means if we are prudent, we have to say that if we cannot know the dividends are from a US company, you will consider that all the dividend and interest are foreign interest or dividends. But if you can check, but I'm not sure because it's like exchange market, so it's not possible to see all the companies you receive the dividends. So from my recommendation, it will be to consider this type of investment like foreign investment. But you can also say to the French tax administration that they have a part of this part of this type of investment will be considered like American sources, because I don't know, you have 100 company, you have 100 American company and 100 foreign company. So you can say, but you have 50% of the dividends are considered like US dividends and 50% like foreign dividends. But for me, it will be complicated to prove that there are US dividends, so it will be considered for the French tax administration as foreign dividends.
No, that's not good. Let's talk about the capital gains then. If I'm sitting with some assets in my stock portfolio, and now I've got to get rid of my foreign assets because I don't want to be getting hit on those dividends later. So now all of a sudden I'm getting, six figures of sales profit that I was anticipating to take to avoid having to have dividends from this foreign company, so I can go buy American companies. Now what do I owe because I'm turning in $100,000 of profit on my sale?
So the capital gains it's the same that dividend interest. You have exactly the same reasonment. So that means if you are a French tax resident, capital gains are taxed in France, but you have the same exception. If you received capital gains on, we'll say, if you sell US investment. So it's the same reasonment.
Okay, but if it's a foreign company that you sell?
If you sell a foreign company, it will be taxable in France, but you can have a credit tax equal to the amount in France because the specificity of the tax treaty. It's a little bit different because capital gains, tax residents' capital gains are taxed in France according to the tax treaty. We have the same tax rate of dividend and interest, so 30%. But capital gains, if the capital gains are also taxable in US, it will have the credit tax equal to the French tax on these capital gains. Rental income from a property in US, for a US property, this income must be declared in France in the French tax return and benefits from a tax credit for the full amount of French tax. So that means at the end of the day, you don't have any income tax on rental income from a property in US.
Oh, good.
You would if you had a property, say, somewhere else, correct? So if you had a property in another country, you're a US resident or citizen, you could be subject to a problem with rental income?
You have to see the tax treaty with this country.
Okay.
It's not the same tax treaty. So you have to study the tax treaty with if it's Spain and France. Capital gains for selling real estate. Like I said, capital gains realized on the sale of real estate are taxable in the state where the real estate is located. However, if you are a French tax resident, France has the right to tax the capital, gains realized abroad. That means the capital gains realized in USA must be declared in France and will be taxable in France. But to avoid double taxation, you can have a tax credit equal to the amount you paid in USA. But that means if you paid less in USA, you have to pay the difference in France. In France, capital gains on real estate are subject to income tax at a rate of 19%, and social security contributions at a rate of 17.2%. So that means 36.2% of taxation. You have an abatement depending on how long you have held the property. So, for example, if you hold your property for over 30 years, you will pay no income tax and no social security contribution, but you have to hold 30 years. If the property is your principal residence at the day of the sale, you benefit from a total exemption for capital gains in France. You have a particularity. If you sell your main residency in USA, after you move to France, let's say you move to France next week and you will become a tax resident at the day of your move because you know that you want to be a definitive resident in France. It's a possibility. Your home has been on the market for a month. In this case, France does provide some leniency for having French taxes on his sale. You have to respect two cumulative conditions. The home was on the market and available for sale before you come, and the home has to be sold within a short period of time, up to about a year maximum. And you have to prove that you really try to sell your home. In this case, you will not pay taxes in France, even if you become French tax resident. You can think that I'm France for 1 month and I'm not a French tax resident at this point, so I do not have to pay taxes in France. For example, you are staying in France for just 5 months before moving to another country will not be considered as a French tax resident because you stay for 5 months in France. Like I said before, tax residency will depend on the fact and circumstances, and there are facts and circumstances that people move to France for their whole life. And in this case, they will be considered like tax resident at the date of the move. As unfortunately, we cannot know the future, my recommendation will be as much as possible that you should try to sell your property before coming to France, because if you sell your property before, France will not have any rights to it. So it's very important.
Wow.
Sandra, thank you so much for all the information you gave us today. It's overwhelming. And everybody, if you are in need of a French tax professional, please email us at warrenjulietravel@gmail.com. We'll put you in contact with Sandra. Obviously, it's not something that's just black and white in all cases. There's a lot of nuanced stuff. It's esoteric. So we hope that you're going to consider Sandra and her expertise when you're making that decision to move to France, if that's the location you're choosing to go. As a reminder, Julie and I, we're traveling the world with our 2 dogs. We're trying to see what it's like to live in different places, different countries, different cities. We're trying to share our experiences and expenses with you. We're trying to show you how to live there if you wish to, talking to experts like we are today with Sandra. So please don't forget to subscribe, give the video a like, and until next time, have a great day, everybody. Bye-bye.